Joey, after we finishing up Halloween, I got a question for you.
Okay.
Do you believe there's an optimal amount of candy one can have in a short 3 to 4 hour window?
Oh, yeah, absolutely. No doubt.
Tell me more.
Well, I think there's this breaking point, like where you want to enjoy the fruits of your labor, your spoils. My kids come home with buckets. I mean, just like we didn't measure it. Like some families, there's one of our family's friends we know, they came home with 52 pounds of candy.
52 pounds. That's like more than your 3 youngest daughters combined.
Exactly. But yeah, there's a point where if you just consume, there's going to be a point where it has to come back up. In fact, that's one of my daughters found that out the hard way.
Ooh, that's what you were telling me.
Oh, yeah, Lily Kate, she kind of got ahead of herself. She was eating candy the entire time she was trick-or-treating.
Mm-hmm.
She's a little thing. She's not too, she didn't have a whole lot of meat on the bones. She's sitting there 8 or 10 pieces in before she gets home.
Yeah, so
and that's when they start with the mounds of candy and they start trading with each other. When you have, 4 siblings, they're just trading like crazy. And then all of a sudden, Dad, I'm not feeling very good. I'm like, what do you mean? What's going on? My stomach's kind of upset. I don't know. I'm just not feeling good. And then it came up.
Ooh.
And all that hard work in the toilet.
Man, that blood sugar level was high.
That's right. Now, what does this have to do with how long I should pay my paid up additions rider on my infinite banking policy?
Well, I would say that there's levels to how much money we should put in our paid up additions rider and for how long. And in this episode, we break down what those look like. And I don't think something's going to come up per se as the candy might have in your house. But I will say there's a lot of topics that are brought up in this situation, and we dive deep. And I hope that you will enjoy this conversation about how long you should pay your paid up additions rider. Let's belly up.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome into the IBC Roundtable, where every week we break down your favorite topic, the infinite banking concept, and we go deeper and deeper down rabbit trails to help you understand the little bitty pieces that makes this a foundational tool to helping us create cash flow that is greater than our monthly expenses. I love this episode because we get to sit around and talk with coaches who are helping you on that journey. And next to me is my partner in crime, Mr. Joey Murray, the Italian Stallion. What's up, Joey?
Glad to be here, and I'm excited that you actually gave me a really great birthday present.
I did?
It was only like a week and a half late, but I'm going to have to post a picture in the community of my personalized license plate cover that says the Italian Stallion. So I'm official.
You are official. And I'll be honest with you, I was a little disappointed that you were able to see it immediately. We put it on your car and did not tell you.
You were trying to hide it.
We were trying to hide it. And you were way more detail oriented than I would have ever been. I would have driven around with that for probably ever. And you guys would have had to come up to me and be like, we put that thing on.
What you're hoping is I wouldn't have noticed it. So you can be like, yeah, man, I put that on before your birthday. I'm surprised you're just not catching that.
Well, I forgot it at home last week. It wasn't on your birthday. I ordered it way before your birthday, like at least 3 to 4 days before. And they did not have it on Prime. So I couldn't get it in the amount of time I needed to.
It's all good. Thank you very much.
All right. Well, sitting next to you is our my favorite man, the man who digs deep into your finances, the person I like to finally call the Indiana Jones of finance, Mr. Ernie Brown. What's up, Ernie?
Hey, Russ. Happy birthday, Joey.
Thank you. Thank you.
And across the table from us, coming all the way in from Texas, the big state of Texas, the $1 million smile, Mr. Incredible, Mr. JD Hill. What's up, JD?
How is everybody doing?
We're good,
Fantastic,
man.
man.
We're good. I'm ready to talk a little bit about something other than politics. I'm ready to talk about how long should I pay my paid up additions rider. So let's start with that conversation, Joey. What is a paid up additions rider?
So in the world of infinite banking, it is an additional rider that's added to your policy above your base premium that is buying additional insurance. It's paid up, meaning it's permanent. It's not going to have to be added to anymore. It's paid up once and for all. And it is adding, because of that, it's adding significant amount of cash to boost the internal rate of return and growth of that policy.
All right. So last week we were talking about different things our dividend could do, Ernie. And we said a dividend could do 4 things. And one of those things was it could be used to buy paid up additions. How is paid up additions different than a paid up additions rider?
Mm-hmm. A paid up addition rider, what Joey just said, is premium that we put in over and above the base.
Okay.
Whereas the dividend elected to purchase paid up additions is taking the dividend declared by the insurance company and earned in the policy. And that dividend is being used to buy paid up additions. So very similar, except for the premium outlay.
Yeah. And basically we have the ability to choose to add that extra money on the front end. And we when we make the decision to fund our life insurance policy, we can choose how much and for how long we put that on there. And that's a really interesting discussion, JD, is talking about how long, because there's some struggles sometimes with how long we internally want to pay this paid up additions rider. What would be some of those issues that you've encountered since coaching with clients on this process?
Issues that I've struggled in terms of like just helping people decide how long that they would want to have their PUA rider on there.
Exactly.
Yeah. Why do you think that question comes up?
Well, I think it comes up for a number of reasons. I think people want to be able to have cash right away, right, which is important, particularly for folks that we're working with. I think another thing is that, you know, people want to create a highly efficient contract as quickly as possible, which the PUA rider helps to solve. And then another thing I think people want also is that they want to create, you know, a tailwind, if you will, of growth from that, making it as efficient as possible so that it helps to propel that policy going forward with sustainable growth and sustainable cash values for a long period of time. And so I think people want a number of different things when they're looking at, you know, how long should they put that PUA rider on there in addition to future cash flows, right? Are those going to go up or are they going to stay relatively consistent? And so when we're trying to unpack that for people, I think sometimes there's not a hard and fast rule, I'll put it that way, as it relates to how long you should put a PUA rider on a contract.
Okay, so that we don't get too far out in front of someone who may be listening to the show for the first time. And excuse me for forgetting that not everyone who listens to the show has been listening since the beginning. And maybe this is the first time you're even hearing about the infinite banking concept. And the idea of paid up additions rider is even more foreign than putting money in life insurance. Break down really quickly, Joey, just help people who may be joining us for the first time. Why do we fund life insurance policies, and how does a paid up additions rider play into that whole conversation?
So ultimately, we're using life insurance as a means to replace the checking or savings accounts that we're used to putting money in. That's where our surplus resides. It's like a warehouse where our money is. And the reason we do that is because it's more efficient. The life insurance policy properly designed, using these paid up additions to overfund in the early years, as we're talking about here today.
When you say, okay, when you say overfund, I want to break that down even one more step, because again, that's jargon. That's something that we understand. But you say overfund, I don't quite understand what that means. That means when we buy a life insurance policy and we put $1,000 a month toward it, it buys a death benefit. And let's just say that death benefit's $500,000.
Right.
Well, overfund means we actually can put more than $1,000 in there. And if we do that, what happens? So let's say we put in $2,500 a month instead of $1,000. What happens?
Well, first of all, we're going to dive deep into some really specific numbers in the Inner Circle section here in just a little bit. If you're not a part of that, I want to invite you into that. So we have a free 7-day trial. Go to wealthwithoutwallstreet.com/inner circle, and you'll have to join the community and then come into the Inner Circle from there. But my point in saying that is sometimes you have to see the numbers to understand the impact that we're talking about. But if we pay that extra $1,500 towards this paid up additions rider, well, let's talk about if you didn't, right? If you paid the $1,000 a month that you mentioned, and it was just towards the death benefit, year one, you're going to have $0 in cash.
That's what Dave Ramsey says. Okay, I agree.
So that's what Dave Ramsey's talking about is, man, this is a terrible place to put money. You don't even have cash value in the first year, or even the first 10 years, he would even claim, right? But if you add the paid up additions rider, all of a sudden, now I'm going to have 60 to 70%, maybe even as much as 80% in the first year of the total amount that I've put towards this.
So if I put $1,000 a month in the policy as a premium, it gives me a $500,000 death benefit. I add $1,500 to that total every single month. That's $2,500. How much cash do I have out of that money available to me at the end of the month that I could use and borrow against?
You're going to have roughly about $1,500.
Okay. What is my death benefit?
Well, I don't know what that would be right offhand.
Well, for $1,000, I got $500. If I put in 2.5 times that, is it $1,250,000?
No, it's going to be significantly less, because when we're buying that paid up additions rider, we're buying it as the lowest possible death benefit that we can purchase with that premium.
You're basically saying we're getting really small bits of insurance.
Exactly.
And that's the reason why most of that $1,500 you put in there actually goes to cash value, correct?
Yeah, because you think about it this way, it's like a seesaw. I think Mark Haraguchi mentioned this. Whenever I have to have very little death benefit, the insurance company is not requiring the vast majority of that premium to go to offset their risk. So now they can offer it back to me in the way of cash value.
Okay. All right. I love just catching that up, because I don't want to take for granted that everybody understands what we're talking about. So a premium, a typical premium for a life insurance policy is required. A paid up additions rider, is that an elective?
Totally optional.
So how does that work? So a second ago, I think one of the common topics that get brought up as it relates to paying premiums or paying paid up additions riders, we could sometimes think of these things as an expense, right? If I see that's $2,500 every single month, that could be, I've got this expense. So what would I want to do with an expense is get rid of it, just like a house. Is that right, Ernie?
Or if any insurance friend that you have in the industry checks on you and they say, hey, I don't know what you're doing in the realm of insurance, but I wonder if I could help you. Maybe I could save you a little bit on what you're paying in premiums.
Yeah.
So do you mind asking how much you paying in premiums?
Right. $2,500.
Tens of thousands of dollars a year. Oh my, you must be doing something else. And that's exactly what's going on here, is that we're not using this policy as an expense. No, we're intentionally putting lots of cash flow into the policy on purpose. And we want to be able to take and use the cash value that we're creating.
Well, but to your point, Ernie, the reason why somebody is asking how long should I pay my PUA sometimes is from that.
That's right.
That kind of thinking process, is they've been trained to think of this as an expense,
That's right.
even by the insurance industry itself. It's such a great point.
And when we sit down and are looking at illustrations in our coaching process, we're in underwriting, we're looking at these. I mean, it's not hard to look at year by year, a large number. And the longer that's on there, for some people that becomes daunting.
Yeah.
How am I supposed to do this for this?
And they're like, well, how long do I have to pay it? Is the question that usually comes up. And that's one context you maybe come into this conversation with now. Another one that I would say, and JD, maybe you can address this one, is I feel like you already mentioned the efficiency. Like, how can I make this the most efficient? I understand this is a good thing, but then the third way that I feel like some people address this is they have a lump sum or a windfall of money and they want to overfund a policy, but they want to figure out, well, how can I do that? And how long should I pay towards PUA or my paid up additions rider with that purpose in mind? How would you address that?
Well, I mean, I think I would address that just if we can put a lump sum into a policy up front, that really helps, again, to accelerate the growth of the policy in addition to, ongoing PUAs. One of the analogies that I like to use oftentimes with people is I say that, the PUA is kind of like rocket fuel, right? I've got 3 boys, 3, 5, and 6, and they are into science and all kinds of stuff. And one of the things that I've learned, through my kids is that, believe it or not, a rocket uses 90% of its fuel just to get out of the Earth's atmosphere, which if you think about just the journey of a rocket, right, that's not a very big part of the journey, just getting out of the Earth's atmosphere, right? There's a longer journey ahead of that rocket. And to think that it sustains itself on the remainder of that 10% of fuel is really unique. Well, the same thing is true as it relates to these PUAs, right? As we use these as kind of like rocket fuel early on in the policy to help make them much more efficient and to really help that base become much more efficient over time.
All right, JD, as we're talking, if you don't mind, I want you to share your screen, because for those who are in our inner circle, you get the value of kind of seeing this live. So I'm going to give you access to that. But you have a great example. And because one of the things that I thought about as we were talking is that when you hear that we have the ability to put this paid up additions rider on there, and you could put it in there in the form of annual contributions, monthly contributions, or as you said, Joey, even the ability to lump sum a bunch of money in the year 1.
That's right.
And we said, when we pay that, in the example we were given a second ago, if we put $1,000 in, we had 0 cash value for the first couple of years. But yet, if we put this $1,500 paid up additions rider on there, we got access to almost all $1,500. So my natural reaction goes, well, wouldn't I want 100% of the premium, 100% of that $2,500 to be going to paid up additions rider? Doesn't that logically make sense?
Oh yeah, absolutely.
So I want to talk about the trade-offs of that. Why wouldn't we want to do that? And JD, you described this very well. If it's all right, I'd love for you to kind of, for those who are watching you go through this, but again, I think even if you're not watching, you still can understand some of the concept here.
Yeah. So for those that are listening, I've drawn, a line across my screen here with like 5 or 6 different notches going down the screen. But basically, so I want to break down the difference between the base and the PUA. And if you went to, an ordinary insurance advisor or and said, hey, I've got $10,000 a year that I would like to put towards a life insurance policy, and they put that all towards your base contribution or your base premium, that $10,000 may buy $500,000 of death benefit, right? And I'm just making these numbers up. So what would happen is that in year 1, when you make that $10,000 contribution, 0% of that $10,000 is going to show up in cash, right? And Ernie, why is 0 only going to show up in cash in year 1?
All the expenses for the policy are taken out early. So all of that premium is going to cover the future death benefit that's going to be paid out, and it's paying the company's operating expenses.
100%. That's right. And, there's a $500,000 death benefit attached to this. And what I would say is that anytime a company is going to make a guarantee, they have to collect those dollars up front so they can make sure that they can honor their part, because they don't know if other people are going to do that. But another thing too, and Russ, this is something that I actually learned from you, and it's interesting, is that unfortunately people do die in year 1. Right. And so they have to be able to set dollars aside to be able to pay for that. And so in year 2, what happens is when you make that year 2 contribution, about 25% of that $10,000 will show up in cash. Right. So it's a little bit better. And so this is why a lot of times when I'm communicating this, I'll say that the base is really designed for the long term. Right. And then year 3, about 50% is going to show up in cash. Year 4, about 100%, year 5 about 100%, and so on and so forth going forward. So this is again why the base is specifically designed for the long term, and it becomes more and more efficient over time. Well, if we separate that and now we look at just the PUA, if we did $10,000 a year towards the PUA, that may only buy $50,000 worth of death benefit. Well, that's a much smaller amount of insurance, right? It's a much smaller amount of risk for the insurance company. And so if I graph this out, what would happen is that in year 1, when you make that $10,000 PUA contribution, roughly about 93% of that shows up in cash year 1. Okay, and again, this is where we talk about like this is rocket fuel, right? So if we just look at it on a year 1 basis, obviously I would much rather have a policy that's all PUA. Well, year 2,
Right.
roughly 93% is going to show up in cash. And every year that I make a PUA contribution, roughly 93% of that is going to show up in cash that now is earning dividends and interest. So what you'll notice is that eventually, and again, this is just a concept, right? But eventually what happens is the base premium becomes more efficient than the PUA. Right around year 4 or 5 is when the base actually becomes more efficient than the PUA. Does that help?
Well, so no, it's really helpful. And taking that as an example, I think that's where you were kind of going there, Joey,
Right.
with the whole seesaw example, is there are trade-offs, right? As you're explaining in year 4 in this example, it's 100% efficient. In year 5, we put $1 in, we have $1.05 going to the account. I've shared this many times, but I own my oldest policy was bought in January of 2010. The growth on that dollar that I put in there last year, just on the base alone, was over 2 times what I put in there. And so I'm at 200% efficiency, if you will, on that specific dollar. Well, clearly the base premium is going to be what propels this engine. It is the growth part of it. The rocket booster part, as you refer to it, JD, and the fuel that it takes to do that, it takes a lot to get these insurance policies off the ground. So it's beneficial to have paid up additions riders on the front end, but there are trade-offs. There's opportunity costs to both. And that's why I feel like this is more of a science than it is, or more an art than it is a science. Would you agree with that, Joey?
Yes. And I would say you are the Bob Ross of IBC.
Oh, yeah?
Just throwing out a little compliment for you.
Because of my hairstyle?
Yes, you do need a haircut, but
Or his
also because you're creative.
thumbnail is just really long. Fun fact about Bob Ross.
Well, here's the part I think that we can really get stuck in the details. And the beauty of the Inner Circle and these podcasts are really to go deeper on those little areas that sometimes can hang us up. And we all want to know, how long should I make this paid up additions rider? When I first started doing this, by the way, there was no example for me to follow. I literally looked at Nelson's book. Most of his examples were 4 to 7 years. I just took that as the gospel, and I started running every one of my policies personally and with the clients I was helping from somewhere between 4 to 7 years. And I would come to Nelson and I would say, hey, I just wanted to check with you and just make sure that I'm doing this the right way. Would you say that putting money in the paid up additions rider for 4 to 7 years is the right amount of time? And Joey, what would Nelson's response to the question like that be?
It would be, I couldn't tell you what it would be because it would be completely like out of left field.
It would be a story about something.
Yeah, it would never be a direct answer, which is why I've always compared him to Jesus. You know, the disciples asked Jesus a question, and there's even some points in scripture where they'll say, do you know what he's saying? Do you understand what he just said? And that's exactly how I would respond to Russ and be like, I have no idea why Nelson just told me that.
Well, I think the purpose is what Nelson didn't want us to do is get too caught up in the weeds of specific things, because that would put a limit on our thinking of it. There are right reasons as to why someone should fund an illustration for 4 years, 7 years, 20 years, 50 years. Never take the base, the paid up additions rider off the policy. There's so many different examples. Everyone's situation is different. As much as we would love to have a one size fits all, apply it, it's simple, we feel good about it, That's not the way this works. That's why this is not typical financial planning. This is not the cookie cutter crap that I used to give people when I was a certified financial planner. Everybody has that's between this age and this age, they have this asset allocation mix. When you're this old, you need to have this much in stocks, this much in bonds. That's not the way this works.
Yeah, no doubt. In fact, most people have this idea of an insurance illustration like it is, it's like the owner's manual. Like this is how it works. This is exactly how it's going to look, and I have to stick to it, and so on and so forth. But really and truly, the vehicle is there to take you to the next stage. It's not meant to just sit there and gather dust.
All
right?
So Ernie, you like to say that there's the functional part to this whole process, and then there's practical. Go through that, if you will.
Well, I love the owner's manual visual, because when you say that, the first thing that comes up in my mind is cars, and actually what comes up in my mind is Jeeps. I really like Jeeps.
I was about to say, I wonder why. You just had two that look exactly the same in the last.
That's true.
Last year,
and pretty safe. So I'm thankful for that. So the owner's manual, we talk about the practical piece. It will tell you all about it. When we look at an insurance illustration, tell you all about it. But what's functional about a Jeep is that it can do things that they're not going to tell you about in the owner's manual, right? You can go park that thing in some pretty crazy ways, drive that thing in some places that's not necessarily an owner's manual. Same thing with when we're practicing IBC. We can't take the illustration that we're looking at as everything that is there. We need to take that and apply this policy, particular to our lifestyle and the things we're trying to accomplish. And we can make the policy work for us, just like we can take our Jeep off the road and make it work for us.
Well, and Russ, I think this is also a good time to bring up how we think about the paid up additions rider from a minimum and maximum standpoint. A lot of times I remember you bringing those type of things up to me early on, and I think it'd be helpful to share that here.
Well, I think when a lot of the discussions I have with people is that when we're entrepreneurial, we have cash flows that are varying and they're not always the same. And we want to take advantage of this system, especially when you learn about it. You've read the book, you've watched the videos, you've been a part of this inner circle. You get super excited. And the number one thing that we want to do is put all the money in there. But then natural reaction happens is like, well, wait a second, what if, right? And so we have this kind of like, okay, how do I guard between wanting to put as much money as I can in there, but always covering the what ifs? And so what we like to talk about is that it should be a minimum and a maximum kind of thought process. The minimum was that base policy that we were talking about. The example we were given a second ago, the $1,000 a month, that's the base policy. That would be the minimum. Well, what would be the maximum? It'd be the $2,500 that I could put in there, that additional $1,500. And the way these policies are designed, it gives us flexibility. So when I'm working with somebody, I love to say, hey, what's the minimum that you can put in this? No problems. If everything went bad, the things that you could think of that went bad, that has a high probability of going bad, not just, the world ends, of course, that nobody can plan against that. What would be the least amount of money or the most amount of money you could put in there in that situation? Okay, here it is. All right, well, in a typical month, everything's going well like it is today. How much can you put in? And that's the ebb and the flow. That's the minimum and the maximum. And that's the way I love to design the policy is I base it upon what's the minimum. That's our base savings amount. That money is long-term savings in my eyes. The money that doesn't show up today available for cash, that's long-term. That's the way we've always been taught to think about money is what am I willing to forego? And then the paid up additions rider, that extra money, well, that's liquid. I know that if I need it, I can pull it right back and apply it to whatever's available for that day.
Which in light of that, I want to bring a really practical thing. Ernie, actually, when we were preparing for this, he brought it up concerning like the way we think about retirement savings and things of that nature as it relates to this model of base and or minimum maximum. You want to share a little bit about how we were talking about that?
You're going to have to jog my memory.
Well, just thinking about like if Americans thought about saving long-term in a policy like this, the way that they've been trained, let's say for 401ks.
Oh yeah.
Right. Share a little bit about that.
When we're talking about creating a saving place, we're always taught this is the amount that I need to put away long term, like we were just saying.
Yeah.
And we're putting money in those places, different types of vehicles, different types of accounts. What if those dollars became the basis that we could put away long term? We're going to get access to it. Like that line JD showed us about year 4 or 5, we're going to like that. But then what if out of our cash flow that we already are putting away into savings that we're going to use immediately, what if we could make that our paid up addition rider? And that'd be another way when Russ is talking about the minimum and the maximum. What if we just did it slightly different way in those long-term savings that we're doing? We made that our base, and our free cash flow, we made it accessible through the PUAs.
Yeah, I like the aspect of it. It's almost, I've been told this by many clients, they love the aspect of infinite banking because it's forced savings.
Mm-hmm.
Well, one of the benefits I think of a 401k is it's forced savings. It's
Mhm.
automatic pilot, right? Well, if we did that, to your point, with the base premium, and we just kept that going, and then we just, charged ourselves to try to use the additional surplus towards that PUA, and then how long would we want to keep it on, by the way? As long as possible. Right. In that case. So,
all right. So I want to finish this discussion and jump in deeper with our inner circle guest and get their questions and thoughts on this, and actually go through some actual illustrations, because that's too hard for a podcast, right? There's too many numbers to discuss, but I want to do that there. But I want to get you guys' opinion. I'll start with you, JD, on this. So if you had the option, knowing out of all the policies that you have today, if you had the option to change the premiums that you're making, and I'm sure you probably have paid up additions riders on some policies, maybe some policies paid up riders have dropped off, but whatever the amount of money you're paying today, what percentage of that money that you're paying today would you, if you could elect, would go to paid up additions, and what would go to base?
Wow. Knowing everything I know now, I mean, it's a tug of war, right? Like I'm at war with myself because of what I know in the short term, and then obviously the big picture and having lived out some of these things. But I would realistically say 50 to 60% I would want to go towards base, and then 50 to 40% I'd want to go to PUA.
All right. How'd you come up with those numbers?
Well, a couple of things. One, I understand that the main driver, obviously long-term, of the dividends, of the efficiency of the contract is the base. And so I would want a larger base, right? A big base is not a problem. That's a really good thing, especially when you're looking at year 10, 11, 12 in the contract, like Russ, your current contract right now. But then in terms of the PUAs, I still would like to have some cash in the beginnings of the contract, right? The first few years. That's right. Richard is all about that base. So yeah, I would,
took my line.
I would still want to have some liquidity in the beginning years of that contract to help make the policy more efficient without having to wait, all those years for it to really become efficient.
All right. And I appreciate that, but also I'm saying, and I'm going to move toward you on this, Ernie. It's not that you have to start a policy with this percentage, but now where you are, if you could change the dollars that you're putting toward the policies, if you had, by the way, this is utopia. This doesn't exist. This is the world I love to jump into, the what if, the magical world of unicorns.
100 unicorns. This section brought to you by 100unicorns.com.
I thought I'd give you a layup there. So if you could, would you say anything different than what JD said, Ernie?
Well, it's so challenging. But your question is where I am now. If I could change my policies, what would I do differently? Well, I just finished creating Caroline's policy. We just got that thing going, and yeah, there's roughly 62% towards the paid up addition rider. But for my policy, I would switch all of it to the base right now.
If you could take the same premium, put it all toward base versus having it split up between paid up additions.
That's right, because I'm better than dollar for dollar at this point.
Now, I love the fact that JD, your answer gives options, right? One of the things that we know, if we have a all base contract, there are options, right? But we have to start surrendering paid up additions. You have to use the dividends maybe to help pay the premium, or take a loan to pay the premium, stuff like that. But if we weren't doing those things, we always can avoid paying a paid up additions rider. and that has no negative consequence. It
Right.
just doesn't allow us to put it in, right?
Right.
That's the big penalty, if you will. You don't get to go back and put it in down the road in most situations. So I like the option part, but I liked your answer too, Ernie. I like the fact to think of knowing what we know now, if I could, which I can't. This is like, Russ, why are you talking about this? I just like to talk about this. If I could, I would take all the money and I would put it in the base right now, because that, to me, what I get most frustrated about when I see that first policy that's almost 11 years old at this point, I see how much I'm putting into that one little policy, and it's not a ton of money. And I see how much it's growing by, and I'm like, ooh, I wish there was a lot more money. If I had that same growth on all 23 other policies that I have now, I would be in amazing shape. So, all right, Joey, I'm going to let you finish this up, but we need to jump into the inner circle. So definitely, if you're not a member, you need to join this at wealthwithoutwallstreet.com/inner circle. Parting thoughts.
Yeah. My only thought would be this is, number one, what you've heard us all kind of talk about today is the base is super important long-term. And you're always, I think, as long as you're practicing this and understanding this, you're always going to wish that base was bigger later when you start seeing this efficient part of the contract. But the most important thing I can say is make sure that you get started. Okay. Get a policy started that works for you today. Buy some term so that you can convert in the future to add to that. And that's really kind of my story. As I had 3 policies early on in the first year, as I've mentioned before on the show. And then in that the fourth policy came along because my paid up additions riders came up, and I still wanted to continue to put that amount of money towards it. And you can do that, but ultimately you're still kind of chasing that number, especially if your income's increasing, because you're like, well, I want to keep paying the $60,000 a year. Okay, well, that's great. But now my paid up addition rider has fallen off and I didn't put it on long enough. That was one of my challenges, I would say, is put your paid up additions rider on for as long as you can, knowing you could always drop it at some point earlier than that, but you can't go past that time frame. And so that would be my parting thought.
All right. Well, next week, we're going to take a similar conversation, but just a little bit different. And we're going to be talking about how long do I have to pay premiums, which I think we're going to probably end up twisting that. How long do I want to pay my premium? But join us next week in the inner circle. And as always, thank you for listening. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.